All right, so we're a few minutes after. May as well kick it off and some more people can join while we're getting started. But we're gonna start with quick intros for the speakers on the call. And I'm gonna lead you through most of the discussion, but we're gonna hear a lot from both Brian and Christina. Thank you again for joining. This is very exciting. So to kick off with bios, Christina, I know from New York. We lived both in New York at the same time. I had joined her angel group, which was really exciting. We worked at Citi together many years ago. Christina, do you want to give a sentence or two on your background?
Sure. Thank you everyone for joining. Happy to be here. I am based in London, UK, but was in New York for about 11 years, where I co-founded Empire Angels, which is an angel network and fund of young professionals investing in mostly seed stage companies together with a focus on supporting young entrepreneurs to sort of peers investing in peers. The group is 80 strong right now and has the youngest membership of any angel group in the country. And for me, it was a great way to get introduced to early stage investing and putting some of my own money at risk to gain that experience. 5 years ago, I joined Samsung Next, which is a corporate venture fund based out of Mountain View, California, where I do deep tech investing across mobile, consumer electronics, and display. So I have both the sort of angel hat as well as venture capital.
Wonderful. And I know you're a regular contributor at the Wall Street Journal. You are doing some wonderful things. I've really enjoyed investing with you. I want to get more active in that group, but thank you again for joining. And then Brian, we are both based in Denver. I met him through my last role, which was working with a private equity investor. And Brian is on a different side of the investing spectrum. So Brian, if you want to give a quick intro on yourself.
Sure, thanks Natalie. Hi Christina, nice to quasi-meet you. And thanks everyone for joining. So Brian Parks, kind of like Natalie and Christina, I share a financial services background, kind of grew up in investment banking, doing mergers and acquisitions for lower middle market companies. So helping entrepreneurs sell their companies for hopefully hundreds of millions of dollars. And then jumped into the early stage technology scene back in 2010 and have been running companies, raising money from angel investors, institutional investors, and the like. And now, as of 2017, coming up on 3 years ago, run an early stage fund focused on software as a service companies, kind of in the venture capital space, but we are a debt fund and we go out and raise money from folks such as some of you on this call, primarily accredited high net worth investors, as well as small institutional investors to invest in SaaS companies.
Great. And I'm Natalie Levy. I recently started and am growing She's Independent, which is a women's empowerment community and business. We want to do things like talk about finance, talk about professional development, do webinars, you name it, mentorship. We'll talk a little bit more about, our organizations later on in the call. My background is I've invested in some early stage businesses, worked in a number of early stage businesses, and I also last worked at a private equity firm that was investing in the lower middle market as well, similar to Brian. So we'll kick it off and looking forward to getting to know you all and answering some questions later on. So in terms of the slides, we're really going to have a deeper conversation. I think this is just to kind of share with you what we're going to cover on this call. Whether you are, looking at getting into technology investing, maybe you're just thinking about what you need to be able to think about technology investing. Maybe you're interested in, what does an exit look like? Maybe you already have exposure. Something to think about is if you work at a company that has given you equity, you're already a technology investor, assuming it's a tech company. So, part of it's mindset, part of it's, educating you a little bit today. We're not going to go into deep, sophisticated, concepts, but we do want to introduce and, discuss some of the fundamental concepts, core concepts of, what tech investing is. And we want to answer some questions. So to kick it off, the first thing we're going to talk about is, what is early stage investing? What is early stage tech investing, I should say? So at a high level, there's direct and there's indirect. I'm going to have Christina speak to direct investing, and then we're going to hand it over to Brian, and he's going to speak to indirect. So Christina, if you want to kick it off with different types of investing, what you've done, and maybe go over a little bit of that landscape?
Sure. I mean, early stage tech investing is it's obviously a private market, and so in that sense, it is fairly opaque, unlike public markets, which people are probably more familiar with investing in. But the basic concept is the same, which is that you're investing in the equity, usually of an early stage company. There are a couple of different forms in which that investment can take. It can be a direct equity investment where a company is selling shares at a certain price and offering them to investors. More often in really early stage stuff, you usually see a convertible note of some kind, which actually sits on the company's balance sheet as debt. It's frankly a cheaper transaction to execute as an early stage company than going through the full equity issuance. It can be done much more quickly. It has sort of standard terms that are easily available, and you don't even really need a very experienced lawyer to help you draft them up. It doesn't require a lead investor, so you don't need someone with a big ticket to come in and set the terms. You, as the founder, can actually sort of set the terms, and those are usually some sort of a valuation cap. So where the debt would convert into equity at a given price, a maturity, which is usually somewhere between 18 and 24 months, and an interest rate, because obviously you want to earn some amount of interest off of that debt. And it usually converts at the next financing round. So when they do actually raise proper equity funding, or at some other agreed trigger. I would say the vast majority of what I see at the seed stage is usually convertible debt. It's not until you get to the sort of next sort of larger rounds of funding, which are then sort of the alphabet rounds, Series A being the first one, when you tend to see more equity offered, but it's mixed. And I would also say, that at the really early stages, one of the things that people can spend a little too much time on is what that valuation should be, or what that cap should be for the note when it converts. Roughly speaking, and it depends a little bit on the geography, the sector that you're in, but the vast majority of seed stage stuff that I see is probably somewhere between usually a $3 and $5 million cap for most companies. If it's a really strong team or a really hot area, that can be higher, in the 7 to 10 range. But ultimately, you should be looking for companies that can, do hundreds of millions of dollars in revenue, that could be worth $1 billion. You should really be looking for the big ideas, ideally, and in that case, the exact number of millions in that really, really early stage round doesn't matter as much.
Great, thanks for that. And Brian, I know you probably have a bit of a different mindset in terms of how you invest, so maybe share a bit about what indirect investing looks like, and then you can also share a bit of that scope of what you think about in terms of valuation, which I think is different than Christina's take.
Sure, I'll kind of tack on to what Christina said with a couple of points. I think if you're going to do direct angel investing, expect to lose your money, possibly. This is not looking for stable returns. This is, certainly a risk-taking alternative asset class to hopefully generate outsized returns over time. And to the extent you can get yourself into a group like Empire Angels, if you're in a city that has an angel group, that's a great way to approach it, rather than just trying to shake down deal flow and assess deals on your own. Doing it collaboratively is a preferred way to do it, I would say. In terms of indirect investing, you can kind of think of that almost like an ETF, right? You're not going out, you're relying upon a manager to go out and originate or find investment opportunities, analyze them, invest in them, and then manage them along the way. And you are kind of investing in that manager and that manager's thesis, their market focus, their experience in doing so. And so you're coming in a, really relying upon that team to do all that work for you, rather than you directly picking any underlying investment yourself. In order to get into those types of situations as a limited partner or a participant in some capacity, you're generally going to need to be an accredited investor, which we don't need to dive into that, but it's got certain income and or wealth requirements to clear that hurdle. And there may be it may be a little bit less accessible than direct equity investing, direct angel investing, because there may be minimums. For instance, you can't kind of dip the toe at a $5,000 to $10,000 check. You may have to have a minimum of 50,000 up to 500,000 for some of these larger funds, certainly. But that's what it is. Think of it, maybe if this analogy resonates, as a ETF, an index fund of sorts. You're getting spread across a portfolio of positions that someone else is managing. And now that can be venture capital across kind of the alphabet, starting at the seed stage or pre-seed. As Christina mentioned, it can be in a debt fund such as ourselves. Our focus as a debt fund and return profile to our investors is certainly different than a venture capital fund. I don't know, Natalie, how much we want to go into that, but there's a lot of different stuff. You can, if you were to invest with someone like Bigfoot, who's lending money to software companies and taking interest in return, let's say, and getting paid back, we deliver our investors interest and their money back along the way as well. So it's more like a bond or a fixed income investment than maybe waiting 5, 7, 10 years for some equity bet that may or may not hit.
Yeah. And we'll get a little bit, I think, more into, and we actually are going to discuss what an accredited investor is. I think it's important to at least know that concept, especially if people have interest, in exposure to tech. If this is an asset class they're looking at, they need to be one. So we're going to get into that next, but thank you both for sharing. I think that some of the concepts we're talking about are a bit more sophisticated. So I want to remind everybody on this call, you are able to share questions via the chat. You should, I think, Bridget, you raised your hand, but if you want to look for that chat on the upper right-hand corner, I think it's the 3 dots, you press more, and then you should be able to put questions in there. You can also email me directly if you don't want it in the chat for everyone to see. That's natalie@shesindependent.com, and we will look at some questions later on. So the next topic I think we should talk about for a few minutes is, who is this appropriate for? People on this call may or may not have exposure to tech investing. Maybe they've heard about angel investing or VC investing. Maybe they, have heard about angel groups through an alumni association, or in my case with Christina, I knew that, I'd worked with somebody and they were starting this member-led angel group, and it sounded really interesting. So, who is this a right fit for? Listen, we could talk about these concepts for a long time, but I want to hit at a high level, talk about what an accredited investor is, and then some thoughts around who it is right for. But by no means am I being a financial advisor and telling you what you should or shouldn't invest in. I think that these conversations are ones that you should very much speak to and have somebody that you work with in a financial management capacity, so you can understand what type of portfolio you want to create. But quickly getting into, what is an accredited investor? There are income or asset requirements. It actually depends based on where you live. So in the United States, if you are an individual, that's going to be $200,000 income the last 2 years and expectation of the same, or net worth of at least $1 million, not including your primary residence. So that's an accredited investor. So, you can't, if you are lower on income or you don't have the assets, you can't just invest in this risky asset class. Something very important to always think about is you never want to put money in that you need a return on, right? This is risky. This is something that you can lose, everything you put in. That being said, there are a bunch of interesting reasons, and we'll get into some of this, as to why we all want to invest and why, we're all excited about the market. So in terms of, some other concepts just to mention briefly, you want to think about asset allocation. I know plenty of people that don't have much in terms of savings, but they want to save something up so they can invest in, a risky asset, alternative assets. That is, not something that I would recommend. Again, you're going to want to work with your financial advisor or somebody who has a sophisticated, background in finance who can walk through this. But as a rule of thumb, I've always heard you don't want more than 10% of your assets going to risky assets or something like this, which again can be wiped out. So let me open that up, I guess, for if Christina or if Brian, if you want to mention or if you want to add to that. But one other thing I'll say is, if you do invest, and even if you are going to get liquidity, it may take a handful of years to even see any liquidity on the back of an investment. Christina, in terms of the profile of what you think about for angel investing, was there anything you would add there?
I think to Brian's point, no one should do angel investing expecting to like make money off of it.
Correct.
I think most angel investors I know, and certainly anyone who has joined our group is doing it for some other motivation, whether that's learning or networking. Some people, a lot of people in our group have, tough day jobs and just really enjoy the activity of meeting with another group of, smart young people to talk about companies and to work with our portfolio and sort of leverage some of their skills in a new way. People, like working with founders. They like sharing their network and connections and experience. It's a way to kind of stay close to what's happening in your city. Generally, if you're investing in local companies, it's a nice way to kind of give back in sort of a volunteer capacity. But certainly, all the money I put into angel investing, it would be amazing for me to get any of it back. And I have in a few circumstances, but I've also had a lot of it just sort of, go away. And you have to just be very comfortable with that concept. I think you run into trouble when people get very, very attached to their dollars and sort of don't understand that these are highly risky businesses, the vast majority of which are going to fail. And then when things go badly, they get very upset. And while no one wants to lose money, you have to just be okay with that as the most likely outcome.
Yep, great points. I love the community aspect. I love learning. If you and I, for example, hadn't made some of those angel investments, I'm sure that when you're negotiating maybe equity with a company, or you're thinking about starting a business, or you're advising a business, there's so much more when you've actually put dollars to work. So I really enjoy it from a learning perspective. Brian, do you want to add anything there?
I think those were all good points. Maybe they were definitely all good points that I agree with. One thing or two things to add. On the direct investing front, also possibly expect that, if you do make some angel investments, a lot of those companies are going to come back to you asking for more. Companies burn through cash, some of which may have been yours, and may come back asking for more. And I've seen that a decent amount where angels, without any folly or intent, maybe overextend themselves into certain positions or across their portfolio, right, and kind of get above that 10% threshold, maybe where they should be operating, because they want to help these companies. They are emotionally invested. They think they need to double down, and there's kind of this sunk cost mentality of, oh, maybe if I put this next one in, I know I haven't seen anything yet, or it hasn't been great, but that happens, and it's something to be cognizant of. I think in the indirect investing space, look, my fund could lose money. I'm very upfront with that with investors. I think the investors that make sense for someone like us is someone who is really looking for a return, right? We are a yielding instrument. We are meant to deliver them return, monthly or quarterly or what have you, not meant for a charitable contribution, let's say, to invest in startups. So it is a little bit different profile. And also, it's worth a consideration. There's no shortage of funds out there that, yes, you can still lose your money, all of it, in any fund deploying any strategy. But maybe you have a slightly better chance of not losing it all from a portfolio diversification and professional management of a portfolio from someone doing venture or something like us.
Great points. So next, let's talk about how equity works. Why should we care about this? Why should we understand ownership, kind of structures, exposure? And by the way, to anybody on the call who maybe doesn't have the financial background, Brian and Christina both are talking about different types of maybe payouts and exposure via different instruments. So it may be a little bit sophisticated, and maybe this is something that you'll read about later if you have interest. But let's just talk about the basic concepts. So maybe I'll hand it to Christina, and if you could give us a little bit more of a breakdown of equity versus convertibles and what you think about or what you look for, when you're investing in an early stage business. When might you want equity versus a convertible, if that's, something you want to speak to?
Well, the preference is always to have equity. I mean, then you actually own part of the company. And ultimately that's where the sort of value creation happens. But at the very early stages, ultimately it doesn't really matter because the company isn't really worth anything in the very beginning at the time that angels are investing. So most of what you're going to be offered is convertible notes, which is perfectly fine. One benefit to the convertible debt is that certainly for as long as it's outstanding and to the extent that it matures and hasn't converted, it sits higher up in the capital structure. So debt sits on top of equity. And so so you actually have, you're sort of better positioned if things go wrong, because you're higher up in that capital stack. So I'm dealing with a company right now where we had convertible debt that matured. There was some funky asset sales going on, and we were fortunate in that we were, because we were debt holders, we have more rates attached to that debt than we would if we had been equity holders at the time. So it ultimately just takes some reading of documents and understanding sort of what the benefits and drawbacks are of each. But I'd say the vast majority of what you're going to see is convertible debt. Most of the term sheets and the documents are very standard at the early stage, so you're unlikely to come across anything really funky or surprising, because it's all pretty standard across market.
Great. Brian, you want to add anything on that?
I do. I may address the question that Abigail put in the chat, and Christina, maybe you can speak to this actually, given your direct experience of how one gets involved with an angel group. Do they need to be investing in order to join? And maybe before you touch on that, I think that last point, 2 points you made, the concept of a capital stack, which is a higher level financial concept, but different return profiles from a debt or convertible debt or preferred equity or common equity, and different rights in terms of who gets repaid first is something maybe for another conversation, unless we want to touch on it here. But back to kind of this standard documentation set for early stage angel investing, be it in a priced equity round or convertible note structure or a safe structure, which is another structure that's out there. All that stuff's fairly well market defined and accepted at this point. And again, I just think that's another benefit of, say, being in an angel group. If you're just dipping your toe or getting into this, is you have people and group managers that are familiar with that documentation rather than going out and trying to, say, structure something on your own if you have no direct experience doing that.
Yeah, and
what else should I talk about?
No, I think that's helpful. I would also say, we can address questions later, but also just to address some of Abigail's question, there are local groups typically. I know here in Denver, there's, multiple groups that are, member-led, or they might have some direction, but you can just join as a smaller investor. I think there are alumni groups with a lot of schools. And the beauty of that is not only do you have the community, but you have that collective input and people with more sophistication. So if you're coming in, you can learn from others, right? It's not like you're in there trying to digest and understand, well, what is this cap table and what does this investment profile look like? You can talk to somebody like a Christina where she knows a lot more than I do. So it's wonderful to be in that room to learn from her through the negotiation of, what we're doing with that business. And it's a valuable experience. So I think there's a few ways and avenues you can look for that. But, locally in Colorado, I know there are some, New York, and depending on where you went to school, I'm sure there's some structures there as well. Something I want to touch on, which, we did a salary negotiation webinar for She's Independent the other month, is equity ownership. So when you join a business, a growth business, or, maybe even a bigger business, they may give you equity. And something I want to touch on, because I've heard a lot of people talk about exposure in terms of shares at a tech company, is the concept that ownership matters a lot more than shares. And understanding what is your exposure and, how much do you have of that business? If I join a business as a senior leader and they're very early, let's just say I want 1%. I'm making this up. The business could say, hey, we're going to give you 100,000 shares, but that doesn't mean anything. It's understanding what percentage. So it's either percentage, it's basis points, which is another way to think about percentages, but shares alone don't matter. And anytime that company goes out and raises, you're probably going to be diluted and have less ownership in that business. So really having a handle on the number of shares don't matter. If you're trying to negotiate or looking to get, more in terms of your compensation package, in terms of equity ownership, having a conversation with somebody with more sophistication around what investing is and around what type of exposure you should have to that business based on your role is a really smart thing to do. So I just wanted to talk about that. I don't know if either of you want to jump in there, but I think that's something that, a lot of people without sophistication, they get excited about shares, but it's not about shares, it's about ownership. So I don't know if anybody wants to weigh in.
I can weigh in with a couple of points.
Sure.
Somewhat related, another one that we're going to totally scare everyone away from early stage investing, which is not the intent. But if you are making early stage equity investments, just back to this concept of a capital stack, and it's applicable to employees as well. If you're joining a tech company or whatever company that's going to grant you equity, it's going to be common stock, which is the last instrument to be repaid in any sort of liquidity event. Let's say the company sells for a lot of money, it's a really good outcome. Everyone else gets paid above common stock and they get paid last. If it's a failure or a fire sale of the company, some people may recoup their money and the common stockholders just get nothing. You can think of a very public recent example being Theranos, a company that raised a ton of money. Probably across common, preferred, the employees absolutely got nothing. All the preferred people got nothing. Some kind of senior lender came in last minute and, took anything that was possibly left. Now that's an edge case, but, stuff like that happens. So, and another thing, so the point I was going to make there with common stock, yes, it matters how much percentage you're going to get. Yes, if the company is successful in raising follow-on equity, you will be diluted. Now there may be an option pool as part of that for employees where you can get future option grants to hopefully not get as diluted. However, you are always going to be, to the extent angel money comes in, a convertible note converts, venture capital comes in, low man or woman on the totem pole in that common stock position.
Yep, very helpful.
As you are in the public markets. If you're buying equities in Amazon, you're in a common stock position. So it's kind of the way it goes.
But we don't think Amazon's going bust, but yes.
Right.
Yeah. Awesome. Next, let's talk about some of the basics of things that we look for when we make investments. And I realize that we invest in different structures, so this may be, very different. One thing I like to mention is negative selection. A lot of times if you are getting into this or you're a new group, you're not going to be seeing great deals. So there's negative selection in terms of the deals that are coming to you. It's great, especially if it's early. You still want to see data points of people want this. Maybe they don't have actual sales, but maybe they have one customer or maybe they have a bunch in beta that are using it. You want data points. You want to, be interested in, does this person have sophistication? Are they driven? Do I believe in the founder if it's early? But what do you look for? So I think, again, it may be different for each of you. Feel free if you want to speak to a sector you like or, a thesis you like. But I just want to say that the sourcing of deals is something really to think about. You may look at 50 deals and invest in one. In private equity, where I worked in my last role, that was you looked at 100 deals and maybe you invest in one, which was very unique. But listen, you're not going to want to invest in everything you see. So please speak a little bit to kind of what you look for. If you want to speak to sourcing, feel free if Brian, if you want to kick it off this time.
Sure. I'll say at Bigfoot, maybe we look at 10 and invest in one, but we're not venture capital. We're not private equity. We're lending money to companies and we do it within software as a service, AKA SaaS. And for us, what we're very sensitive to is putting debt onto a company too early, right? Unlike equity, debt is meant to be repaid with some return. So doing that too early in a company's life cycle is just dangerous for all parties and likely not appropriate. So for us, we focus on companies with, generally at least $1 million in revenue, which in SaaS is recurring revenue from selling subscription software. It's very high gross margin profile. And if you're selling, so we look for, say a minimum of 20 customers. If you're selling enterprise software to big companies, minimum of 200 customers, let's say, if you're selling to small businesses. And for us, that's validation, traction, data that we can underwrite to as someone making loans to these companies. And so we get very metrics and data focused. Of course, we care about the founder, the market, the credentials of the team, how long the team's been working together. But generally speaking, when we get involved, the company has been around for at least 2 to 3 years, some up to 8 to 10 years. Maybe they've bootstrapped it and just grown a little bit more slowly. They're not necessarily extremely interested in selling equity at the point in time when we engage with them. And so we're a good capital fit there. Just to say that we're not a good fit for companies that have no revenue or have not sold anything yet, or just getting into going to market and don't really have any clear signs of repeatability there. They may be doing great, but that's more of an equity position rather than us coming in. Does that make some sense?
Yeah, absolutely. Christina, you want to jump in?
Yeah, I mean, I think, for me, sourcing, one of the reasons that we started Empire Angels is because, to what Natalie was saying, like I had friends who were starting companies asking me for money, and I was very curious if there were people doing similar things that were doing it better than what my friends were doing, and maybe that would be a better investment of my money. And so I do feel very strongly that working with other people, even if it's just a small group of friends, it doesn't have to be a big network, is going to get you better, more high quality deal flow, and help you better evaluate opportunities than if you do it by yourself. Generally speaking, unless you have a really amazing network and really, really strong, consistent deal flow, you're going to end up picking, not seeing sort of the full breadth of opportunities if you do it all by yourself. I don't have any particular sort of specific sectors that I look for as an angel investor. I mostly am a people investor. So it doesn't have to be an area that I necessarily have a particular strong passion or understanding about, but I'm most interested in investing in founders who can convince me that this is the thing that they're most passionate about, and it's a big problem that needs solving. And I found that anytime that I've made an investment in a team where I was a little bit iffy but thought that the opportunity was just really amazing, those usually end up doing poorly, and those founders often are the ones who give up more quickly, as opposed to the ones who really sort of dig in their heels and are in it for the long haul regardless of what happens.
Yeah, I think those are great points. And I would even expand on that a little bit more, which is, listen, in early investing, early business growth, there are so many pivots, so many things that you need to do as a founder, whether you're looking to optimize, you might have to change the strategy a number of times. So the people really matter. You need a strong team. It's not going to work out the way that they plan. Decks and, presentations and financials, it never works out the way that they plan. So you want people that are really good, people that are really dedicated, committed, bright, ones that are going to follow through and be okay with, those transitions and pivots.
Yeah, and I'd add on almost the concept of alignment between the capital coming into the company and the company itself. This is a long game, right? Like, there are no overnight successes. It is very, very hard. Uber, for instance, I don't know, is it 10 years to an IPO? Like, people have had money in that company for a long time and, got liquidity along the way. And of course, it's like a mega success, of which there are a handful that you can point to almost in any given decade, right? And I think a lot of us may get fooled into a narrative of that is the common outcome for early stage investing. It's absolutely not. But, just to circle back to the point, come into this knowing it's a long game. You're looking to support these founders for, 5-7 years with no return expectation along the way, because that's the journey you're signing up for at the early stage. Which, again, to juxtapose that with the public markets, public markets companies may have been around 20 years, 50 years, what have you. You're getting in very late stage, and you can get out whenever you want, right? You may make some money, you may lose some money, but those are the benefits there, which is just totally different.
Yeah, helpful. So I think we'll just take a quick summary of kind of what we've reviewed, and then we'll move into Q&A. So quickly, let me change my slide. Having spent a little bit over half an hour talking about this, and I realized, we touched on a lot of these concepts lightly, take a look at your personal financial situation. Is this something that sounds interesting to you? Are you willing to, play to get involved maybe in the community or to support some businesses? Again, don't do this looking to get rich tomorrow. That's not what this is for. But, are you in a position where you're interested and you can expose yourself to these assets and get involved? So maybe you're not. Maybe you say, I don't have the assets or I don't have the income I need, but I really want to get involved in tech investing. Maybe you need another job. Maybe you need a job that will make more money, and then you're able to, you know, as kind of a side project, invest in, you know, tech businesses because maybe that's a passion or something that you really want to try out. In terms of, you know, how to get involved, you know, there were some questions on this call that we addressed, but look for those local groups. You can reach out to really any of us speaking on this call today. She's independent, you know, offers, whether it's webinars, we're going to do some that are earlier stage talking about basics in, you know, your financial independence. I know that Brian offers some things and he can speak to that in just a minute, but we want to be here, you know, as resources and as support. Get involved. So I don't know, maybe as a closing remark, Brian or Christina, if you want to mention books or, you know, there's so many different websites today that put out regular newsletters that might be interesting, you know, feel free to share a little bit to the audience in closing here. Christina, if you want to kick it off.
Sure. I mean, the best thing is just to start doing. You know, if you're serious about making investments and have some capital to put to work, you know, start meeting with entrepreneurs. This is an activity that you only get good at as you practice it more. You can read as much as you want, and I'm sure there are some very good training programs that and boot camps, if that's the kind of structure that you feel you need. This is really a learn by doing activity, and I think it's important to just get used to the flow of hearing a pitch and figuring out what questions to ask and what kinds of things you gravitate towards and what kinds of things you don't, and that'll help you give a better sense, get a better sense of what it is that you're most interested in. In terms of things that I do think are worth reading, you know, I think it is helpful to just sort of know what's going on in the market, and maybe that's because I come from a finance background, but I highly recommend there's two daily newsletters, one from Fortune magazine called Term Sheet, and another one from Axios, that just sort of give you a rundown, usually of some interesting news that's happening in the tech and startup space, and then all of the sort of interesting funding rounds that have been announced, and that just helps you to sort of understand what's getting done in the market, at what price, you know, what are investors finding interesting, that kind of stuff. And then the other thing that I read every week is a newsletter from one of the partners at Andreessen Horowitz, which is a big Sandhill fund. His name is Benedict Evans. He sends a Sunday night newsletter out where he rounds up all of the sort of news and interesting tech reads for the week with a little bit of analysis on why he thinks they're notable. And for people who are busy and get too many emails anyway, this is sort of the one piece of sort of market data and like longer reads that I pay attention to every week.
Wonderful. Brian?
Yeah, I'd say ease your way into it, right? If we're approaching 2020, start going to pitch events, explore an angel group, maybe visit some of the newsletters that Christina mentioned, but you're kind of learning, right? I think it's possibly dangerous to just go out and stroke a check just because you're eager to stroke a check. Like maybe you should have seen 25, 50 pitches, get a sense for that, have conversations, plug into ecosystems, be that accelerators, even co-working spaces, just get yourself in the mix if you're not there. Please don't masquerade as an angel. There's a lot of that out there, which for founders is extremely frustrating and counterproductive. So it's fine to say, hey, I'm considering angel investing. No, I haven't run it. Just be transparent. And I think you'll find that people will be eager to support you in those efforts.
Great. So now to Q&A. Feel free to send questions over. It looks like Bridget has one in the chat. And her question is, it sounds like the likelihood of losing money is pretty high. Does anyone have numbers on the proportion of these investments that actually succeed?
I'll speak to us as a debt fund. Our goal is for 100% of our investments to succeed. Our goal. But again, it's very different. It's a very different form of investing than, say, angel investing or being a partner, a limited partner in a venture capital fund where maybe 70 to 90% are expected to fail, and you've got 10%, 5 to 10% that are just going to be massive returns within venture capital. That model works. That model does not work for someone like us who says to our investors, hey, your money is going to come back, and it's going to come back with return being cognizant that we would expect to lose some percentage of the money that we loan out on any given year or over time. And we have to manage to that, but just a very different outcome than equity investing. So I don't have stats or data around
sort of
how much of
accepted
that
wisdom among
actually
I think
just
most angel investors is that of 10 investments, probably 6 of them are going to fail completely. A couple of them will kind of peter along and not really do anything but sort of exist as companies. You may have one that returns your money maybe plus a little bit, and then one that returns everything else. So the economics are really that you're going to have all the investments you make, you're going to hopefully have one that does really well and makes up for the losses and all the rest of them. And that's why investors are always very focused on only investing in companies that can get really big, because that's the only way that those economics work out.
Yep, great point, Christina. I would also point out, I've heard, and maybe the 1 in 10 is one way to think about it, but don't even think about investing with any type of return. And again, be ready to lose it all. If you can't invest in at least 10 or 5, 10, 20, you're not going to have diversification in that portfolio. So if you only have enough money, let's say 10% of your net worth only allows you to put 50 grand to play. Are you going to be able to invest 10K in 5 businesses? Maybe that's okay, but maybe you need exposure to 10 to even start thinking about not losing your money. So yeah, one investment is typically going to pay for the others. That's why Christina's point, I think, is a really strong one of you want to go for things that, can win big.
Yeah, and on the indirect investing front, I mean, the same notion applies. While you may be getting diversification in any given fund, because they've got a portfolio of companies, you're still going to be concentrated to one specific fund manager, and any fund can underperform. And so you would possibly look to spread that out as well, which requires certainly some wherewithal beyond, say, $50,000 to play with.
Great, that's helpful. Anybody else have questions? I know we have some people sitting in silently, and if you didn't find the chat, you can click the upper right, the 3 dots more, and add something there. I'm also going to check my email to see if anybody wrote me.
There's one from Tiffany.
Great. So Tiff asks, what are some interesting deals that you've done recently, angel or later stage? Either of you want to jump in on that?
I can start. We're kind of boring. I call us simpletons. It's really unfortunate. I'm excited about the companies that we invest in, with the belief that we can help them and they can pay us back, and we in turn can pay our investors back. But just to say, we're not really moonshot type investors. We're not investing in consumer tech. We invest in what some could view to be boring B2B tech, even serving very niche. It could be software for dentist practices, which on the surface is not the sexiest thing in the world, but can be a very nice business and can produce good outcomes for everyone involved with that business, which is energizing and interesting to us. We did just have a company that had a very successful M&A outcome that we were able to support, and we were able to support later on in their life cycle for a company that had not raised much equity capital, so was able to retain the lion's share of the proceeds from that M&A transaction, and we were able to facilitate their doing that. They needed some capital, of course, to get them through kind of a certain phase, and they didn't have to go out and shake down angel investors or go through some 6-9 month venture process. Like we were a very nice solution for them at that point in time, and those are the outcomes that we look to help support.
Great. I might add my favorite investments are the ones I get liquidity on. So that's where my mind goes. I like getting liquidity, but I'm still excited about, some of the deals where my money is still at work. I, would say that whenever it comes to exposure and opportunity to invest in or, exercise options, with a tech company that you participate in, I like to do that because I like to remain aligned. I just received some liquidity from a real estate tech investment play. So I was excited about that. And I'm still, on for the ride as I still have exposure to them. but yeah, I would say in terms of deals, I don't want to play in something that feels overly saturated. I still like security. You know, I think that's a space that's a really exciting one. So I guess I get a little bit more excited if somebody has a security company, whether it's B2C or B2B. And I like to dig into those, or data analytics if I think it's offering real value.
I would say as a VC, I'm spending a lot of time looking at what I'm sort of calling consumer empowerment. So companies that are helping consumers to use technology in smarter, healthier ways. Companies that help to combat things like surveillance capitalism, that provide data privacy and control to consumers. I think it's a very timely topic, and one that people globally are paying a lot more attention to. As an angel, I can just run you through like the 7 companies that we looked at last month, just to give you a sense of the kinds of things, like the really wide variety of stuff you can see as an angel. We looked at second largest mortgage app for your phone in the US, so you can actually apply for mortgages on your mobile device, believe it or not. A group dining reservation platform, a beauty marketplace for textured hair, a mentorship community for students around the world, a new platform for secure money wires, an online network for high school student athletes, and a platform for death and memorials. So it's a really wide set of stuff that you can see as an angel. And I think the best part of it is being able to get together with a group of smart people and try to look at this stuff that you may or may not have a lot of expertise in, but it can be really fun to figure out together.
Awesome.
Which of, if any of those, do you think will get funded through Empire Angels?
The 2 that ended up being most interesting were the beauty marketplace for textured hair, because that's a massive market that's actually pretty under or poorly addressed, I would say. It had a really, really strong founding team, 2 women. And then the platform for memorials and death actually had a lot of interesting statistics around why particularly millennials would be interested in using a digital product to plan some of that for themselves or for their loved ones. Those were the 2 that I think from a market opportunity and team perspective are and also have actual momentum behind their fundraising, which helps.
Great. One point that I realized we hadn't made, and I know we're running out of time here, Natalie, so we haven't really talked about domain expertise, right? Like, I don't know what the people on this call do in their professions, but let's say you've worked in healthcare for 30 years. Let's say you've worked in, industry XYZ. It can be a natural fit. And I think founders can very much value angels that have domain expertise in a certain industry, that maybe bring a lot of experience to bear, bring relationships to bear. And that can be a natural kind of initial place to look and deploy your attention and time as someone getting into early stage investing.
Absolutely. One thing I want to ask, and it looks like we may not have any more questions from the group, but something that I think is helpful for entrepreneurs or people that are maybe participating, on this call today. What is a piece of advice you would give somebody if they are looking to raise capital? And that could be, super early stage. That could be somebody that has some revenue. Is there anything that, you kind of see as maybe an error that happens when people are pitching, or, what do you really look for ultimately so that they can show you that they've done their diligence, they're excited, they want to work with a sophisticated investor? Maybe Christina, if you want to kick it off.
I would say a big tip that I always give to entrepreneurs is just be honest and transparent. There's a temptation to be honest, to lie about what it is that you've accomplished or can accomplish with the resources that you have. And the best thing that you can do is under promise and over deliver, which is much better than claiming that you can do certain things or have accomplished certain things and that comes out later that you didn't. You want to establish really strong trust between you and the people who are funding you. It's a very long-term relationship, and integrity is something that you can't earn back usually. So starting from a place of honesty, I think is really important.
Great point. Brian, you want to add anything?
Yeah, I mean, I'll speak from the standpoint of, say, a first-time founder who's never raised capital before, because it's very different if you're someone who's been successful and raised capital along the way. It can be much easier, but it's from a founder standpoint, it's a slog. You have to approach it systematically, process driven. It is a sales process. You can't expect it to happen overnight. So you kind of just have to really woman or man handle a process of trying to generate a lot of interest, manage through that interest, align people on a timeline, and really be systematic about that, which people may not quite appreciate the importance of doing so. And I've written some about this, our blog at bigfootcap.com/blog. You can also sign up for our newsletter there. We talk about things such as this and a lot of software related stuff. And I think, the honesty and transparency and really being true to yourself. Like, I think I've made this mistake before of, I've raised money for a company I started pre-product, pre-revenue, certainly. And I would, if I start another product company, I would never do that again just because it doesn't fit me. I get comfortable and I'm much more compelling. I'm not a good bullshitter. I'm much more compelling telling a story based on data and results. Some people can spin a yarn and it's not necessarily an untruthful yarn. It can paint some massive vision and just have that energy and charisma to attract people. Other people have a different way of going about it. So I'd say don't try to be someone that you're not, because it likely will not succeed and will fall apart over time. The only other thing is, as Christina mentioned, build trust, right? That trust building could take 12 months. So engage with people over time, show them that you're producing results, show them that you've done what you said you were going to do 3-6 months ago, and just be transparent with all of that.
Great. We're coming up on the hour. I think that was really helpful. If we don't have any more questions, I think we'll close it out. Thank you both so much for joining today. And we will circulate a recording of this to the people on the call and then also to the folks that signed up that weren't able to join today.
Great.